Matt Orton is now joining us. He's Chief Market Strategist at Raymond James Investment. Matt, great to have you with us here. Thank you very much, as always, for your time. Prashant this side. Matt, so we get into one more FOMC, and this one is close once again. So which way are you leaning? Is it going to be a pause, or there are those like, for example, I think the global economists at Citi who are expecting a hike in June as well? What's your sense?
Hey, good morning, Prashant. Always good to see you. My sense is that we're going to get a pause. Like you said, it's going to be close. I think there's going to be some division within the voting members, but I expect we're going to get a pause, and then it's going to be a hawkish pause. So I think what's going to be most important later on today or tomorrow for the U.S. markets is, or Wednesday, sorry, is really going to be what Powell says. We get the CPI data tomorrow. I'm not sure how much of an impact it's going to have either way, unless it's much, much hotter than expected. Then I think a hike comes back into play. But base case is a hawkish pause. Listen to what Powell has to say, because I think he's going to continue to guide and emphasize that this cycle is not necessarily done. They are still going to be data dependent. Inflation has been sticky, and we've seen a lot of volatility with respect to the economic data. So as I've been saying, really, all throughout this year is that we need to take the Fed at their word. When they say they might not be done, they really might not be done. And I think the main message for investors is that higher for longer really means higher for longer, and a pause does not mean a pivot. So again, I've been enthusiastic. It's great to see the rally. I think we've gotten some of that right, but overall, this is a time to still lean into higher quality companies, because globally, the economy is in fact slowing down. You want to own earning stability. You want to own profitability, free cash flow companies. And breadth is definitely a challenge in the US market in particular. And those higher quality companies that may have lagged the AI rush in technology, that's what will work if breadth improves. And it's also what's going to work in case you see a little bit of consolidation.
Okay, so you're expecting a hawkish pause from the Fed, and you're saying lean into quality companies. But it's been a spectacular ride, right? I mean, the NASDAQ is up almost 30% this year, and now big tech has come back in a big way, whether it's Apple, Oracle, Tesla. What do you do about that pocket, and in general about equities? Do you see more upsides to global equities, especially the US, irrespective of which way the Fed goes?
I think it is going to depend on which way or how hawkishly the market interprets the Fed. Because at the end of the day, a lot of the mega cap names that have driven almost all of the gains for the US equity market this year, a lot of them are higher quality companies. You can't deny that Apple and Microsoft and Alphabet that are throwing off $100+ billion of free cash flow along with improving earnings momentum. You can't say those aren't quality companies. They definitely are. But I spent the past week traveling and talking to clients, and my biggest message to them is risk manage your position sizing, because it's perfectly okay to still own those companies going forward, because there are long-term secular growth drivers to them. You want to have them in a portfolio, but take some chips off the table, take a lot of the gains that you've had, and think about redeploying that back into other parts of the market, because those higher quality parts of the market, they've done okay, but they haven't kept up with tech. And again, if you do see consolidation in the market, those are the names that are going to hold up the best, and that's what I want to own. And again, if the gains are going to be sustained for the market, breadth has to increase, where we're sitting at historic levels of narrowness for the US equity market. And if we're going to see sustainability to this bull market, we have to see more sectors, we have to see more stocks participate in that. And again, that comes back to those companies that have missed out a little bit. So it's all about asset allocation, and I think that's what's going to be the winning trade at the end of the day.
All right. Hi, Matt. Good morning. Nigel on this side. Matt, I wanted to ask you about this hawkish pause that you're talking about. So you mean they paused this time and they could return to hiking? You're clearly not factoring in any rate cuts, at least in this year.
No, Nigel, I think, as I've said a lot, whenever we've met, and what I've said consistently this year is that I do not expect the Fed to be cutting this year. I think the only scenario in which the Fed cuts rates this year is going to be really, really bad for the overall market and economy. You have to see precipitous decline in economic activity in order to get the Fed to start cutting rates. And I just don't see that in the cards. That the data has been pretty benign. I mean, you've had some good data, you've had some bad data, but nothing's been that bad that would signal a pause, and nothing's really been so fantastic that you can't say growth is going to slow down. But it's been good enough, and for me, that presents opportunities in the overall market. But do not expect a cut.
Actually, there are three central banks which paused. Right, there was Australia, there was Canada, there was Norway, and guess what? All three have started hiking again. So, but I mean, smaller banks and smaller decisions as compared to what the Fed has got in front of it. But point taken, Matt. Great to speak with you. It's always a pleasure. And thanks very much for being here on CNBC TV18. Well, we'll take a quick commercial break here. Our top stocks to watch lined up next in just a bit. We are back with our research team.